If there is a downturn in equities, having some part of the portfolio that maybe moves in the opposite direction of equities, something like commodities. Or again, what's the reason? If the markets turn down because perhaps inflation unexpectedly rises, interest rates go up, well, making sure that you're not holding long duration fixed income, which may lose money on that. So I think there are different ways to do it. There's no magic bullet. But I think if you know your goals, you're working with your financial advisor, and you know what you're trying to achieve, particularly if you're a long-term investor, stay the course. But if you can find products that help either reduce risk or raise return and ultimately better diversify the portfolio, that's how you ride out these downturns. But I think the key is looking at your goals, thinking about diversification from day one. But the beautiful thing that ETFs help do in that process is this concept of mass customization. Even if you have as little as a $500 or even $1,000, now the size of ETFs are so accessible, you can get pretty diversified with even a $1,000 portfolio with 3 or 4 ETFs. But I think, again, if you're in the position, you can find good financial advisors who understand you, help you understand what you're trying to achieve, then they can really put that portfolio in context. You've seen ETFs continue to build market share, even in accelerating market share, even in a downturn. So I think all these qualities that investors have come to love about ETFs, lower cost, transparency, the easy access, in many cases tax efficiency versus mutual funds and other wrappers, it's really hard to see where the market share gains and the growth of ETFs really slows down. This is technology innovation, I think, in many ways, and I think this digital wave is growing in so many parts of our lives, and ETFs is going to be an integral part of most people's portfolio going forward.